Bismillahirrahmanirrahim. Today we will learn the advantages and disadvantages of the net present value as well as advantages and disadvantages of internal rate of return. We have discussed these tools in detail in the playlist given in the channel, that is capital budgeting decision making. So videos are given in the detail with the calculation manually and in Excel. We have discussed in detail the implementation and interpretation, the result of these both tools, which are better. We will check it now, and we will discuss in detail which tool is better. So advantages of the net present value. A key advantage of net present value is that it is a direct measure of the expected increase in the value of the firm. Net present value is theoretically the best method, no doubt, and we will check the which is the better. The theoretically it is the best method, and mostly analysts use this method. So it's this is the main advantages of the net present value, that measure of the expected increase in the value of the firm. Every individual, every institution, investors, and large or small scale firm, what they need only profit, increment in shareholder value, and NPV is the best tool to choose the project. So its main weakness is that the disadvantages of the NPV is that it does not include any consideration of the size of the project. For example, at a net present value of $100 is great for a project costing $100, but not no great for a project costing $1 million. So it is a drawback of the net present value. The advantages of the internal rate of return is that it measures profitability as a percentage, showing the return on each dollar invested. The internal rate of return provides information on the margins of the safety that the net present value does not. So this is the main benefit of the internal rate of the return. From the internal rate of the return, we can tell how much below the internal rate of return estimated return the actual project return could fall in percentage terms before the project become uneconomic. So fall below the, so maybe negative, net present value may be negative. So the disadvantage of the internal rate of return is that the number one weakness is that the possibility of producing ranking of mutually exclusive project different from those from net present value analysis. This is the first weakness. And second weakness of the IRR is that there is a possibility that there is a multiple internal rate of return, or there is no internal rate of return for the project. So in this way we can not conclude, and we cannot get result from the IRR. So we have to use other tool like net present value. This is the year, you can see. This is year. Here you can see. And this is project X and this is project Y. 0 to 5 year initial investment both is same, that is 1000, and cash inflow of project X is 500 each year, and cash inflow of project Y is 0 for the 4 year and 4000 at the last year. Here we will calculate the NPV. Now we will calculate the NPV and IRR for the both projects, and we will interpret and we will conclude that which tool is better to select or reject the project. So as you know, capital budgeting is all about to selection or decision making to choose the long-term project while using the financial tools NPV, IRR, payback period, etc. So here we are actually calculating that the conflicting project ranking and which tool is better, NPV or IRR. So calculate the NPV for the project X. Go to the function bar. Here is already NPV maybe there. So we will find the financial, and here we will find net present value, NPV. Go. So here is NPV. Okay. What is rate? Here rate is given 10%. The discount rate is 10%. Here the discount rate, sorry, let me write down the discount rate. The discount rate is 10%. So the discount rate is 10%. Here we will calculate the NPV of project X. Go to the formula bar and select the NPV, and then select the rate. Here is the rate, and then the value from first year to last year, that is this, and then click the OK button. Okay, here is the something went wrong. Then again collect the NPV. Actually I calculated it in the 7 version. So click the rate, and here is the value 1, value 2 are 1 to 24 payments, and income equally spaced time and occurring at the end of the each period. Okay, so we will select this. This is actually incoming, and value 2. So then click the OK button. So this is the value we will add. Here we will add the initial cost, that is this, and then enter. So here is 895. It is given in the rupees, but actually this currency is in euro. In the example mention euro currency. So here we will select the currency. So currency is euro. What's happened here? We will select the. So actually this amount is in euro. So we will select the currency euro here. Here you can see, you can select the euro, and I am going to decrease the decimal to the 0. So here we will calculate the net present value of project Y. So select the function bar, and then select the NPV OK, and then select the rate, that is 10% for both project, and value from here you can see that 0 to 5 year, and so this is the amount. Then add, here you can add the initial investment, that is this. So it is our net present value. This is again in euro. So select the euro currency and decrease the decimal to 0. So this is the net present value of project Y. And same like internal rate of return, click the function bar, then here you can put the financials and select the IRR. Then go, and here is IRR. Okay, and value is an array or a reference to cell that contain number for which you want to calculate the internal rate of return. So here we can select the values, and enter. So 41% is the internal rate of return of project X, and same like we will calculate the internal rate of return project B. Okay, and select the values from 0 to last year, and then okay. So 32% is the internal rate of project B. So let me highlight the result here. You can see here, you can see this is the net present value of project A, and this is the internal rate of return of project X, and this is the net present value of project Y, and this is the internal rate of return of project Y. So I am going to change this color. So in green color they are most likely good. So the net present value of project X is less than the project Y, and the internal rate of return of project X is greater than the project Y. So let's interpret the result here. Project X has a higher IRR, here you can see, and but project Y has a higher NPV, here you can see. Which is the better project? If project X is selected, the firm will be worth the euro 895 more, because the present value of the expected cash flow on euro 895 more than the initial cost of project Y. However, it expected to increase the value of the firm by euro 1484. Project Y is the better project because net present value measures the expected increase in wealth from undertaking a project. Net present value is the only acceptable criterion when ranking projects. So keep in the mind, net present value is the only acceptable criterion when ranking project. Another reason besides cash flow timing difference, the net present value and internal rate of return may give conflicting project ranking is differences in project size. Let's consider two projects, one with an initial outlay of $100,000 and one with an initial outlay of $1 million. Let's consider the two projects. One is $100,000 and other is 1 million. Other project is 1 million. These are the two projects. One is 100,000 and second is 1 million. The smaller project may have a higher IRR. This Smaller project may have smaller IRR, internal rate of return, but the increase in the firm value, net present value, may be small compared to the increase in the firm net present value of the larger project, even though its IRR is lower. It is sometimes said that net present value method implicitly assumes that project cash flow can be reinvested at the discount rate used to calculate net present value. This is the realistic assumption, since it is reasonable no assume that project cash flows could be used to reduce the firm's capital requirement. Any funds that are used to reduce the firm's capital requirement allow the firm to avoid the cost of capital on those funds just by reducing its equity, capital and debt. The firm could earn its cost of capital on funds used to reduce its capital requirement if we were to rank project by their IRRs. We would be implicitly assuming that project cash flows could be reinvested at the project's IRR. This is unrealistic. And strictly speaking, if the firm could earn that rate on invested funds, that rate should be one used to discount project cash flows. So maybe there is the problem with IRR. Maybe in some projects there are multiple IRR, and maybe there are no IRR problem in the project, so then we cannot conclude on the basis of internal rate of return. So net present value is the best tool to choose the project among the number of projects in capital budgeting. So these are the learning outcome, conflicting project, that which tool is best. So usually the net present value is the best, but in some locations like European countries tended to use the payback period method as much or more than the internal rate of return and net present method. Size of the company matter. The larger the company, the more likely it was to use discounted cash flow techniques such as the net present value and internal rate of return. Public versus private companies used to payback period more often than public companies. Public companies tended to prefer discount cash flow methods. Management education matter. The higher the level of education, like MBA, MS, CFA, the more likely use the company was to use discounted cash flow techniques such as net present value and internal rate of return method. So this is the way to decide which project is better in capital budgeting. It's all about capital budgeting. So next we will inshallah discuss the some examples, some problems related to these tools. Thank you.